Hey everyone, this is Adam Carey, CFP, Certified Financial Planner. Today I want to talk about a couple things that I've been wondering. We learn more in finance about behavioral finance and what that means. All that means is we're human, we have emotions, and we make decisions on our investments and all of our financial life based on emotion. You have a TV, you need a new television, you go to the store. Which one do you choose? There's 20, 30, 40 of them to choose from. Small, large, which brand, different price ranges. But you usually go with what feels right. The problem is, in the investment world, sometimes going with what feels right goes against, it's counterintuitive to what actually we should be doing in the market. Example, buy low, sell high. We've all heard that. But what happens, unfortunately, and one to give a good example is most recently during the inflation or the tariffs, when we heard that there would be tariffs coming, the markets had one of the biggest drops in the history of the market for a few years. So I think that that's an important concept because we have emotion. We buy, we sell our investments based on emotion. And here's a statistic that I want you guys to really pay attention to. The average investor earns 2.29%. Compare that to the investor who works with a financial advisor. They earn an average of 4%, around there. Why? Why having a financial advisor prevents you from making so much? The problem is that when you have an investment advisor, they kind of act like a guardrail. They're there to kind of stop you from making those decisions. They're like, whoa, no, not a good time. Don't invest right now. Or, hey, don't sell. I know the markets are really all over the place and very volatile, but please don't sell because you're locking in those losses if you sell. That's the number one thing I want you to take away. You sell at a loss, it locks in that loss forever. Let me do a comparison. If you just invested in gold, I hear people all the time, oh, I only invest in gold. I don't trust the American dollar. I don't trust the government. So they buy gold. They invest in straight up gold. And they hold gold. They don't sell it when the markets are up and down because that's their security blanket. That's their safety net. They know, hey, this gold isn't going to go anywhere. So they sit on gold. Did you know that they would earn an average of 5.88%? That is nearly 6%. Compare that to the average investor who's buying and selling and trading and looking up, oh, I heard Apple's a good stock. I heard Amazon's a good one. Ooh, Tesla, they're looking good. Everybody looks for these big Mag 7s, the big headlines, and they're buying and selling based on emotion. And because of that emotional component, they're only earning 2.3%. That's a huge difference. That's almost a 3% difference if you had just bought gold. Now, I'm not saying go buy gold because the average stocks and the S&P 500 has averaged about a little over 10% over the history of the markets. Average stock portfolios return about 7.6%. So, and that's having an advisor. You have a potential of earning almost 7-8% by having a financial advisor who knows how to develop a portfolio, select the correct asset class based on your risk tolerance, and then from there, you let them manage it. You have a lot of say in it. You have all the say. You can tell them buy, sell if you really want to at the end of the day. They have to do what you want them to do. But having that advisor as kind of a block, another step that you have to take, gives you a chance. Like, I had an argument recently, and what I hear all the time is don't react instantly. Step back, pause, and take a breath. That one breath may be what you need to prevent a big blowout with somebody or a big argument that you will regret saying what you did later. Same thing with investments. Having to turn to your financial advisor before you have an emotional reaction to a market volatility based on the latest news headlines, that advisor is that breath. You have to actually talk to that advisor and say, hey, look, I'm thinking I want to get out of the market. And the advisor, who is in this all day, every day of his life or her life, they can actually say, hey, look, maybe now's not a good time. Just hold on. Let's just watch the market. And you do. You take their advice. Next year, you realize, hey, I made almost 8% in a stock portfolio. You wouldn't have done that if you had been just like, oh no, I don't know what's going to happen. The markets are going to go down. I'm going to lose everything. I better grab what I can now. I want to say this just because I'm not trying to get you to work with me. Find a good advisor. Find someone that you know and can trust. As a certified financial planner, my job is a fiduciary. A fiduciary is a fancy word that means I'm loyal to you. So if you're working with an advisor, make sure that they're a fiduciary. Make sure that they have the training and the skill set. A certified financial planner has gone through one of the most rigorous programs and one of the most difficult tests in the financial industry. So does it come with some trust? I'm sure it does. So here we are. That was our summary today. Thank you, and I look forward to talking to you next time. Again, Adam Carey, CFP.